where we tear through the latest analysis reports to give you the nuggets of knowledge you actually need. Today, we are looking at Opendoor. You know, the iBuying giant that has for years lived under this huge cloud of skepticism.
Mm-hmm.
And if you follow this space, the story is almost always the same, right? It's all about losses, cash burn, imminent failure.
The headlines love that narrative.
But deep in their latest Q3 report, analysts found this massive, almost counterintuitive signal that is quietly starting to change things. So we're just going to skip right past the headline loss and focus on one number.
And that's really our mission for you today. We need to unpack what this huge surge in positive free cash flow, or FCF, actually means. You know, the big questions are, how did they pull this off in such a tough housing market? And more importantly, is this a real turnaround, or is it just a temporary defensive move?
Yeah, a maneuver to survive. But the market, it definitely reacted. The stock popped over 4% right away. And we're seeing big firms like JP Morgan starting to quietly raise their price targets, looking out towards $8. So this deep dive is all about synthesizing why that cash flow number is sparking that kind of optimism, especially when they're still reporting a loss.
Okay, let's just get right into it. The number that has, fundamentally shifted the conversation is this $432 million.
And positive free cash flow?
Exactly. Positive FCF for the quarter. I mean, that is just a colossal figure, especially for a company that was basically being called a cash vampire just, 18 months ago?
It's transformative. It really is. To get why this is so critical, you have to remember the old Opendoor model.
Growth at all costs.
Growth at all costs, exactly. They were just spending cash constantly to buy more and more homes.
Sure.
And that led to all the criticism about them burning cash. This quarter, that entire historical criticism is just flipped on its head. It signals a massive tactical pivot away from that aggression towards strategic survival and, optimization. So let's talk mechanics, because I think this is where the genius of it is. This FCF, it's not profit, right?
No, absolutely not. It's cash generated by liquidating their inventory. So imagine you run a massive used car lot and a recession hits.
Okay.
You might decide to sell off a ton of your older cars really fast, maybe even take a small loss on what you paid for them just to fill your bank account with actual cash.
So they're just clearing out the old stuff. Homes they bought, back when their pricing models weren't as good or the market was totally different?
That's it, exactly. They're converting those illiquid assets, the houses,
Yeah.
into cold, hard cash faster than they're buying new ones.
And the direct result of that is what the analysis report is calling a financial war chest.
Yeah, a war chest.
Yeah.
Their total cash on hand is now getting close to $1 billion.
Wow.
And that level of liquidity just radically changes their risk profile. It's the difference between, driving on fumes and having a full tank of gas when you know you're headed into some really rough, unpredictable terrain.
So you don't just hoard $1 billion to sit on it. What's the bigger strategy here with all that cash?
The plan is pure patience. It's positioning.
Yeah.
They want to survive this current environment, these cripplingly high interest rates, and all the housing volatility. The analysis suggests they're really targeting market stabilization, which, most outlooks are putting somewhere around 2026. This $432 million in cash flow, it basically just bought them a much longer, much safer runway to wait for that moment.
So they can re-enter the market aggressively when things finally turn in their favor.
That's the plan. Now, we absolutely have to maintain some balance here. We can't let that shiny $432 million number, blind us to the fact that operationally the quarter was still pretty tough.
Right. Let's do the reality check, because the negative numbers are still there. The pain isn't over. Revenue came in at $915 million, which, it was missed. The expectation was closer to $922 million. They're selling fewer homes, which means less top-line volume.
And that shrinking volume, that's by design. That's a direct result of this new strategy. They are intentionally pulling back from riskier markets, from riskier deals.
Prioritizing discipline over market share.
Which leads us right to the net loss figure.
Net loss. It widened to negative $90 million. That's an EPS of negative 12 cents. So on paper, when you factor in all the costs and overhead, they are definitively still losing money.
And this is the critical distinction for you to get your head around, the difference between net income and free cash flow. Net income is the accounting, the on-paper profitability, and they're losing money there.
Right.
But FCF is just about the movement of liquid cash, and they're generating that cash by liquidating assets. It's the shrinking to survive story personified.
Sacrificing the short-term paper profit for long-term survival.
You got it.
But doesn't that create its own risk? I mean, if they keep shrinking and pulling back, don't competitors like Zillow or OfferPad just come in and eat their lunch? How long can you stay in survival mode before you've lost too much ground?
That is the multi-billion-dollar question. And it's the core risk that the analysis report really highlights. The bet that analysts are making is that Opendoor's technological moat, their data, their pricing algorithms, is deep enough that they can afford to retreat for a bit.
So they think they can just flip a switch and scale back up.
That's the belief. that their ability to scale up profitably once the market turns is more valuable than holding on to risky inventory today. The question everyone is asking is, can they pivot back to profitable growth the moment the macro environment shifts without, having lost too much consumer trust or market position during this hibernation?
Okay, so this is where it gets really compelling for me. Despite the revenue miss, despite the net loss, why is Wall Street, the most cynical part of the market, suddenly getting bullish?
Because they're looking forward, not backward. Firms like JP Morgan, they're not grading Opendoor on its Q3 report card. They're grading them on their trajectory out of Q3. And that's why you see that $8 price target for late 2026. They believe the company has successfully fixed the internal engine while everyone else is still getting battered by the external storm.
And the core of that confidence is what the analysts are calling a major transformation. And this seems to pivot on two things. Aggressive cost cutting, okay, but also the implementation of new AI pricing models. Let's dig into the AI part. That feels like the linchpin here.
It absolutely is. The old iBuying model got killed by risk, especially during that boom-bust cycle in 2021. Opendoor was buying homes too high and holding them too long.
And then the market turned on a dime.
And they had catastrophic losses. This new AI model is designed specifically to eliminate that kind of risk.
Okay, so how? What's different about this AI versus the old one that, kind of failed?
It's all about granularity and speed. The new models are hyperlocal, they're analyzing way more data points, they're integrating dynamic stuff like current interest rate forecasts, neighborhood-specific supply, and, crucially, their own data on how fast they can renovate and resell. It lets them price their initial offer much, much closer to the eventual quick sale price.
So the margin for error is way smaller.
Way smaller. Think of it like this. The old system was fine when prices only ever went up. This new system is designed to give an almost immediate risk assessment. So they don't buy a home, they can't flip into cash within, say, a tight 90-day window. It minimizes their holding costs and the risk of being stuck with a depreciating asset.
And that tight risk control, that's the whole game. The analysis suggests that with cost cutting and this AI, they can reach adjusted net income break-even within the next 12 to 18 months.
It's an incredibly aggressive timeline, but it all hinges on this transformation actually working.
We also have to talk about the market mechanics here, because the technicals are being driven by all this fundamental news, but the momentum, well, that's all about the short sellers.
Absolutely.
With about 14% of the float shorted, any piece of genuinely surprising good news, like this huge cash flow number, it forces those shorts to cover their positions. They have to buy back shares.
And that buying pressure creates a technical squeeze. That's exactly what fueled that 4.12% surge we saw. Traders are just capitalizing on that mismatch between the good news and the high short interest.
Yeah, the stock closed at $6.07 recently, right at the high of the day, which shows some real conviction. And you have to remember, this stock has climbed all the way back from a 52-week low of, 51 cents?
It's a massive recovery, a complete reversal in sentiment, really, from near bankruptcy to a genuine recovery story.
So if the fundamentals are looking sound, the cash, the AI, the 2026 outlook, how is the market pricing that in right now? What are the key levels people should be watching?
Okay, so there's a really crucial technical principle at play right now. The key support level is $5.80.
$5.80.
Okay. And that level is so important because it was a major resistance level for weeks. It was a ceiling the stock just could not break through. The fact that it broke above it and is now holding above it means that former resistance has successfully flipped into new support. Holding $5.80 validates this whole uptrend.
So that's the floor now.
That's the new floor. And above that, the main resistance, the next big hurdle, is between $6.50 and $6.
Got it.
The chart itself shows this classic higher low setup, which just means the dips are getting bought up really fast. So if the price can stay above that $5.80 floor this week, the technical path to test $7 is, well, it's wide open.
Just wrapping this all up, what does this actually mean for you? Let's just summarize the verdict here from the analysis. Profitability, meaning net income break-even, it's not here tomorrow. They are still losing money on paper. But this unexpected $432 million in cash, it achieves something absolutely essential. It buys them time, it buys them liquidity, and it buys them confidence from the market to actually execute this massive transformation they're attempting.
So the final actionable advice really depends on your investment horizon. If you're a high-risk growth investor, focused on a multi-year turnaround.
Have some patience.
Exactly. Then this current price range, especially as it consolidates around $6, it looks like an accumulation zone. You're basically betting on that AI pivot being successful.
And for traders?
For anyone trading the immediate momentum, the most specific level to watch is a really convincing break above $6.15. If it clears that level with some real volume, that's when the short squeeze and the rally towards that $7 resistance really begins in earnest.
And we want to leave you with one final thought here that kind of ties all these threads together. If Opendoor managed to generate $432 million in free cash flow, a massive amount of liquidity, under the severe housing market volatility of 2023.
Yeah, the worst conditions imaginable.
Right. So if they did that, then how dramatically will their new advanced AI models accelerate their return to actual net profitability when the broader interest rate environment finally stabilizes, as everyone projects it will in 2026?
It suggests that when the wind is finally at their back, this company could pivot from defense to aggressive, profitable growth, well, almost overnight.